But yeah. So I don't, let's see what happens by Monday, and then I might have some time on Monday to talk about that. But today I want to get through chapter 4 in its entirety. So that way Monday, we'll do this to finish the spreadsheet, and we'll talk about the simulation. You have another round due this weekend. So at this point, if I could just ask for not even your attention, just your quiet. So those are people who are talking, stop talking. Do whatever you must on your iPhones, laptops, computers. That's all fine. Just a little silence. I get distracted easily. Okay, chapter 4 starts now. Mark 4. The long-term and short-term financial planning. So I'm going to tie this chapter into what we're doing in the companies you're running, as well as some of the spreadsheet work that we're doing for budgets. And the long and short-term financial planning, so companies have to look at both of these elements. How do we, as a company, make sure that we have enough cash for the short term as well as the long term, because we want to be able to grow the company in a predictable way that shareholders are accustomed to. Now, if you look at Amazon.com, they had a brilliant short-term and long-term financial plans that enabled them to lose money every year for a number of years before they actually made a profit. The only way they were able to do that is by having a plan that was clearly communicated to both their investors and their employees on what the purpose was and how they were doing. And their long-term strategy was build and grow and get bigger to dominate commerce. So in this chapter, we'll be talking about the financial planning process, both long and short term. Long term is more strategic. Where do we want to go as a company? And short term is more operational. So companies like Uber, Lyft, Grubhub, these delivery companies, all short term, they're all losing money. But their long-term strategic plans are to make money. So sometimes when you're in the building or growing phase, just like in the companies you're running, you're not the most profitable right now, but you're investing, buying factories, buying operational equipment. So you long-term, 4, 5, and 6 years, you're able to greatly increase your sales and profits. So in the companies you're running, you want to also look at that and think not just for the round you're working on, the year you're working on, but the whole set of 6 years. We're going to talk about tax depreciation procedures, and what depreciation is. And we're going to talk about statement of cash flows, operating cash flows, and we're going to look at, of course, the statement of cash flow again, the difference between free cash flow, operational cash flow. We're going to talk about preparing a budget, the use of a cash budget. And we're going to explain the procedures that lead up to and how you evaluate a pro forma financial statement. That is something that we're dealing with in the companies. The simulation is bringing up these creating these pro forma financial statements that you're using, and how to evaluate that, use those statements to move a company forward. Okay. So in the first slide, the financial planning process. So we want to think, where do we want this company to be in the long term? And financially, what is it going to take to get there? So if you're a new fast food company and you have a good idea for a fast food location and you want to bring that worldwide, your long-term strategic goal is to expand this operation into every country and every city around the world. That's going to take a lot of long-term financing and capital to do that. So operating both in the short term and long term is going to take a big planning process. And most of these companies eventually have to go public to gain the necessary amount of funds to ensure that they can become the next Starbucks or Chipotle Mexican Grill, and really expand that idea. But it takes years and years and years to do that. So that long-term strategic plans are vital to communicate with your shareholders and your employees so they know what you're doing. So they don't worry if you're losing money this year. We're losing money, we know, but once we get another 1,000 restaurants online, we'll start to become profitable. And the short-term operating financial plans are really just to keep the lights on, keep the employees paid, and meet the short-term needs of the business, making sure the cash is always available to pay payroll, pay the utility bills, the rent, things of that nature. Just like you personally, you should have a short and long-term goal. Short-term goal is really get through this semester, financially have enough money to pay for all your needs. And it's difficult because you're not able to work if you're going to school full-time, or you're not able to work full-time. Some students are working part-time. But you have to really look at those goals. And the whole reason that you're sacrificing now is to obtain that college degree and have obtain a higher-paying job so you make more money in the longer term. So the money that you're giving up now by not working full-time and going to school, in your long-term plan, you're going to make that back once you're working and making higher salaries after college. Now, when we look at cash flow, one thing that we have to think about is depreciation. So depreciation is recognizing when assets are losing value and reducing our profits by that amount to reduce our tax burden, our tax liability. Sort of like if you're doing your personal taxes and you take a deduction off of your income, you're going to pay less taxes because you were able to take a deduction like a dependent or maybe interest on your mortgage. But for companies, they have actually a couple choices of different depreciation systems to use. For finance, we prefer that companies use the modified accelerated cost recovery schedule. And this is a system to determine the depreciation amount of an asset for every year. And the assets would be into categories that would be detailed by the IRS. So the IRS would say, these assets belong in these categories, and these categories get this rate and time of depreciation. So it's all spelled out by the IRS. Now, we had a new Tax Cut and Jobs Act of 2017, so that required, so prior to this 2017 law, firms were required to depreciate most assets under this modified accelerated schedule. However, the new law allows companies to immediately deduct or depreciate 100% of the cost of a lot of new assets. So that's sort of this immediate deduction was a way of improving the economy. So the idea is that if companies were able to deduct their investments, they might be more motivated to make the investments since they can deduct it right away, and it's going to lower their taxable liabilities. So it's a better deal for businesses. So it was part of to get businesses to expand and reinvest and grow their businesses, because growing businesses hire more employees. Okay. So there's a procedure that we use. We basically depreciate a certain percentage of the asset every year until it's fully depreciated. And the percentage that is depreciated that year, we get to deduct from our taxes, or deduct from our incomes that lowers our taxes. And examples are, we do these in the spreadsheet, of course, so I'm going to pass that example. Now, the depreciation is what we call a non-cash charge, because no cash was actually lost. So for example, if you're driving a car and your car, without you even realizing it, from last year to this year may have lost $1,500 worth of value. Did you lose $1,500 in your bank account? No, your cash, nothing changed in your cash situation. It's just that your car as an asset is worth less. So when we calculate cash flow, we always add back depreciation because we subtracted it out of our profits earlier. So we want to add that back, be able to calculate most forms of cash flow, because it's really not cash that we're spending. Okay. So the other methods that you may have been introduced in, say, an accounting class would be a straight line method, a double declining balance, the sum of years and digits. So as a company, you're free to use whatever method you feel is most appropriate for your company as far as depreciation. But by and large, most financial managers prefer the modified accelerated cost recovery schedule because it's accelerated. You depreciate more of the assets sooner than later. So a straight line method would be the same, depreciate the same amount every year equally. The modified accelerated method, you depreciate more of the assets up front, so you get more of the tax benefit sooner. And it's better to have money sooner than later, so that's why we prefer this accelerated schedule. Now, this has a half-year convention, which I talked about last class, where the first and last year are only considered 6 months. So if you have a 3-year depreciation schedule for an asset, a 3-year asset, there's actually 4 periods, because the first and last year are 6 months, and that together are 1 year. And then you have 2 full years. All right. So you typical categories are 3, 5, 7, and 10 years, where these are just some of the definition of these categories. For example, computers, copiers, printers are in the 5-year category. Office furniture, manufacturing equipment will be in the 7-year category. Petroleum equipment and refinery and some tobacco products are in the 10-year. So it depends on what the asset is, because some assets expire quicker than other assets. You know, for example, whenever I've owned a PC, Windows PC, those seem to depreciate faster than a Mac. So I have a MacBook from 2013 that still works great. But I've gone through 3 or 4 PCs since 2013 because it seems like every 2 years it just doesn't really perform well at all. So you can see that different products, different types of assets have different years of usefulness before they need to be replaced. This is the schedule here. So you can see the 3-year schedule has 4 periods, 6 months and 6 months, and then 2 full years. And the 5 has 6, the 7 has 8, and the 10 has 11 periods. So like we did in the spreadsheet, you just multiply the base of the asset by the percentage for each year to get the depreciation amount for that asset each year. And you can see for some companies that a whole position job position can be used just for keeping track of assets, depreciation, calculating the depreciation, because companies could have thousands and thousands of assets they have to keep track of for tax purposes. Now, you also need to keep track of these assets for the fact that if the asset is sold at a certain point and it's sold for more than the current value of it, you may owe additional taxes. If your depreciation was faster than the actual real value, so for example, you had a car and you depreciated it from $20,000 to $2,000, so the vehicle has on the books value of $2,000. You sell that car for $10,000, you owe $8,000 of taxes to the government because definitely now that you sold it for $10,000, that's the real value of the asset. So it was over depreciated. So that's why companies need to keep track of this, because sometimes when assets are disposed of or sold, they have to be adjusted tax-wise for what reality is to where the depreciation, the IRS scheduled depreciation puts it, because they're not synced up 100%. And there are plenty of companies that may have depreciated an asset 100%. They've had it and they've fully depreciated it, but it's still working fine and they're still utilizing it. Okay, so here's just a basic calculation that we've seen on Monday. So the costs of the asset, the base value doesn't change. So if 40,000 is the base value, that stays the base value every year, and we just multiply the rate by that base and to get each year's depreciation amount. Okay, and we use that depreciation when we're calculating our cash flows and our income. Now, this is what I had started to tell you a little bit when we're talking about the financial statements. We're talking about different sources of cash flow. So we have cash flow from operations or operating activities. This is the best cash flow ever, because this is from running the business generating cash. So the only businesses that are really valuable ones are the ones that generate cash. So getting cash flow from the operations of the business is what business is all about. You want to run a business that's going to generate more profits than your costs, so you have generated cash for yourself. Some companies can also generate cash flow from investments. They can invest in other companies' stock. They can invest in, other investments such as real estate, machinery. So cash flow from investments are going to, if you're buying an investment, it's a negative cash flow, but when you sell that investment, it's a positive cash flow. So when McDonald's invested in Boston Market and McDonald's invested in Chipotle Mexican Grill, later sold both those investments at a profit, that's cash flow from investments or investing activity. Cash flow from financing is borrowing money, right, or paying back money. So cash flow can move in either direction. You borrow money, your cash flow increases. You pay that money back, your cash flow decreases. That's why cash flow takes or needs an analysis, because you want to know what direction is the cash flow coming in, because some cash flows, if our cash flow is coming in from operations, that's good. If it's coming in from investments, that's very good. But if it's coming in from financing activities, we realize that that cash has to be paid back at a later date. So we might see a company where the cash flow went down a great deal, and that may concern investors, but if the company explains, or if you look at the financial statements, you say, okay, actually operating cash flows went up, overall cash flows went down because they made a rather large investment in buying another company. Sort of like Disney spent, was it $72 billion to buy 20th Century Fox? So that's going to, if part of that transaction was paid for in cash, that's going to be a hit to their cash flow. But investors will understand when they explain, like, this is an investment that will pay off more in the future. Okay. So developing a statement of cash flows, we have to characterize for each activity in the company, is this adding to our cash or taking away? Is it a cash inflow or is it a cash outflow? So a decrease in an asset, if we decrease an asset, we consider that a cash inflow. So if inventory goes from 20 million to 15 million, we consider that a $5 million cash inflow. If there's an increase in the asset, that's a cash outflow. If we buy another building, we buy another factory, just in your companies, when you buy factories or buy operational investments, that's cash outflow. You see your cash balance decline. And some people try, usually I get an email, I can't submit the simulation, what am I going to do? I did everything right. Clearly there's a problem with the computer. And I look at it and I say, well, you have a $200 million worth of cash deficit. That's why you can't complete it. And I see that you bought 10 factories for each vehicle class. Why? Oh, I just wanted to have them. And you see how that's a bad, scenario, having factories you're not utilizing, and that's why you can't advance the simulation, because you overspent. You didn't have enough cash flow to finance that. You increased too many assets, and too much cash was devoured. Decreasing a liability is an outflow of cash. So if your credit card, you have $10,000 outstanding balance on your credit card, and you decrease that to $2,000, that means you took $8,000 of your cash to pay off that part of that credit card. That's why it's a decrease to an outflow of cash. If you increase a liability, we consider that an inflow of cash. And it's sometimes hard for people to understand this, but I'll put it to you this way. You have $2,000 worth of cash in a pile on your desk, and you have a credit card also on your desk. So instead of paying for all your meals and entertainment and bills this month with your pile of cash, you took your credit card and paid for everything on your credit card. We consider that an increase in cash flow because we didn't use our cash to pay for anything, we used the credit card. So we increased the liability. So increasing those liabilities led to a bigger pile of cash because we weren't spending the cash, is how it's looked at. But that's utilizing financing to increase your cash flow by borrowing money or putting everything in debt or not spending cash when you're buying things. So again, inflow sources of cash, decreasing an asset, increasing a liability, net profits, depreciation is an inflow of cash because we add that back, and then sale of stock. Outflows, buying an asset, paying off a liability. any net loss from the company, paying dividends, or repurchasing stock. So you can clearly understand this is the basic makeup of how cash comes into and out of the company. So when we develop a cash flow statement, we look at a year-over-year change in a lot of these categories to put together a cash flow statement so we could clearly on paper see every in and out of the activities of the company. Something that if you did in your own life, it may help you to better understand your spending. One thing I do at the end of the year is with my credit card is that they automatically put everything in category based on where I purchase things, whether it's travel, meals, entertainment, automotive. So I always like to kind of put that in a spreadsheet and then put a pivot table in there and see what percentage of my money is being spent on these different categories. And if I see that I'm spending way more by eating out, then I will have to look at that more closely, make some decisions next year. So it's a way of really me doing a little cash synopsis on, my spending habits. So companies have to be a little bit more detailed when, they classify all the transactions of the company. So things like depreciation, which is the reduction of value of a physical asset, or amortization, which is the deduction of a value of a non-physical asset, like a copyright or like a character. But these are non-cash charges, so they should always be added back to cash flow because we took them out of our cash to lower our profits. We need to add them back to get an accurate cash flow account. So non-cash charges, we want them not to affect our cash flow because they don't in real life affect our cash flow. Okay. Okay, so in preparing these cash flow statements, we want to see what the change in profits were for the company, look at the depreciations, all the outflows and losses, dividends paid are going to be treated as negative values. So here's an example cash flow statement, and we start with, now this is an income statement to start. So we start with, of course, we know how an income statement works, but we're really interested in this this money available, the cash, the profits the company generates. And of course, when we look at the balance sheet, this is how we can tell if there's a change in, say, inventory. So in 2018, inventory went from 900 to 600. So that's a $300 reduction of inventory. That's a $300 increase to cash. So we use the balance sheet year over year to see how different things, like we can see here, land and building went from 1,050 to 1,200. So that was a 150 increase, meaning that additional land and building were purchased, and that's a reduction in the cash flow. So we look at how the items changed from 2018 to 2019. For buying assets, our cash flow is going down. If we're paying off debt, our cash flow is going down. And if we have a net loss, our cash flow is going down. So we look at the change between years in these funds. So here's an example. Once we get the difference, so if we see here, here's that 300 decrease in inventory by 300. Here it is on the cash flow statement. So where does 300 come from in inventory? It's from 2018, we had 900. Now we have 600 in inventories. And that translates on the cash flow statement as a decrease in inventory. Since this is a positive amount, this is an addition to cash flow. So the company picked up cash from profits, adding back depreciation, a decrease in accounts receivable, a decrease in inventory, an increase in payables. So an increase in payables is a cash pickup because we're putting things on account, we're not paying for them yet. And then we had a decrease in accruals. So that's something I need to explain. Why does decreasing in accrual decrease cash flow? So an accrual is like a liability. It's basically something we owe that we've been accruing, and it's been increasing. So we could accrue our payroll. So it means that for 2 weeks we haven't paid any payroll. We owe our employees money, but we haven't paid them yet. But it's been accruing, and then suddenly we decide to pay them, and then that's a decrease in the accrual because the accrual goes to zero, and then we pay all our employees. So the accrual is sort of like something we know we need to pay for, but we haven't paid for it yet. And once we do pay for it, that's going to reduce cash. So say, for example, if you were renting a car or renting an apartment, and the landlord let you accrue the rent for 3 months, meaning that you wouldn't have to pay the rent for 3 months, but at the end of that 3 months, you'd have to pay the rent. That 3 months worth of rent's accrual until you actually pay it. So it's just an accounting stipulation there that if you weren't familiar with that activity. So cash provided by the operations. So these are all operational activities: accounts receivable, inventory, payables, accruals. This is all part of running the company. Cash flow for investments. We have an increase in fixed assets. So we increased the fixed assets. That brought our cash flow down by 300. So here's the fixed assets from 2,200 to 2,500. You see how that increased by 300? And that increase in those fixed assets is a reduction in cash. So that could be buying another business, buying a factory, buying a real estate location, and investing in machinery. And here we have cash provided by investment activities. So we had $300 that went into another investment activity. Okay, so in cash flow from financing activities, we paid off some notes payable. We increased our long-term debt. We had paid a dividend. We had some cash from financing activity. So this gives us a net increase in cash of $557. Okay, so if you add all three of these together, the cash from operating activities, you add to the cash provided by investment activities, to the cash provided by financing activities, you get the total net increase in cash for the company. And this 557, you'll see here, 500 to 1,057 is the difference in the cash account. So if you want to know what the difference in the cash flow is, you could just look at cash from 2018 to 2019. It'll tell you the net difference. But the reason we put this cash flow statement this statement here is so we can understand how that was developed, where it occurred. So rather than saying, okay, the cash account is increased by $557, that's nice, but how did that happen? Is that good cash coming in from the operations or less good cash from actually financing? All right. So the statement of cash flow is put together for, to look at really to dissect how the cash is operating, coming in, and going through the business. So if we're interpreting the cash flow statement, we might want to know what operating cash flow is, OCF. So operating cash flow is a critical element of understanding how the business is doing. How is that calculated? Well, first, think about it. Operational cash flow. It's the cash flow from operations. So from generally normal operations. So it's NOPAT plus depreciation. So what is NOPAT? Is an acronym for net operating profits after tax. And then if we, which equals EBIT times 1 minus the tax rate. So net operating profit after tax plus depreciation, that's our operating cash flow. Cash flow from operations. So calculating the OCF is really just a shortcut to know what is the operational cash flow. Okay, so again, there's the formula. We also have free cash flow. So this is something else we may want to look at. So this is the cash flow available to investors and owners. So after all the operating cash needs have been met and the investments have been paid for, we have the free cash flow. So again, we're adding one additional thing to this formula. We're looking at taking the operational cash flow, subtracting out the net fixed assets, and subtracting out the net current asset investments. So this tells us the free cash after really the financing activities, investment activities of the company. So think of it this way. Operationally, the company made money. After we take away the money the company spent to reinvest in it, buying operational investments or new factories, the remaining is the free cash flow. It's free because it has no more obligations on it. The company has been run and the investments have been made, and the remainder is the free cash flow. Okay. So those are just two formulas that sometimes to really shortcut the financial statement using a ratio. Show me the operational cash flow and show me the free cash flow. And that's something that investors like to analyze. Okay, so moving now into the cash budget. This is something we were working on in the spreadsheet the other day. So the cash budget is really a way for companies to keep track of the cash in the business, the inflows and outflows, to help the managers better estimate the short-term cash flow. So the sales forecast is critical to that. This is something that many of you may have a problem when you're running your companies, forecasting your sales. So luckily for you, you have a pretty good guidance. You get the growth of each car in the industry from the user manual, and you also get data on how many cars you sold last year, as well as a guided. There's a table that gives you a guided average of what sales should be every year if everybody was equal. So it gives you a pretty good box to think about what the forecast is. Real companies don't always have those advantages. So they have to go with the data, the past data of how things were sold, seasonality, and that external and internal data. So internal, we're looking at, what we've actually sold previously. External could be economic factors that are going to be key inputs to this sales forecast. So this external forecast is going to be relationships we're going to have between our product and key economic indicators. So if our product is sensitive to the economy does well, our product does well. So maybe it's a luxury good, yachts. So if the economy is doing really well and the rich keep getting richer, more yachts will be sold. But if there is an economic meltdown, a stock market collapse, and the rich don't feel so rich, they're going to put off buying these giant luxury goods like yachts. So that's how you make that connection between the economy. And that's also true of automobiles. When there's a recession, car sales tank. That's why in the last recession, GM and Chrysler almost went bankrupt. The government had to step in, lend the money to keep them afloat. There's a lot of criticism that the administration took for supporting GM. And at the time, the Democrats were in power, the Republicans were not in power, and the Republicans said, this is a horrible idea, we shouldn't be doing this, and ranting and raving about it. And the Democrats were like, this is a no-brainer. We have to do this because millions of people will lose their jobs. If it was the other way around, if the Republicans were in power and the Democrats weren't, the Republicans would have supported GM and the Democrats would have said this is not good, because that's how they work. They just kind of oppose whatever position, Same thing with the budget deficit. When the Democrats are in power, the Republicans run around saying, the deficit, no one's looking at the deficit, you can't elect any more Democrats, they'll destroy the deficit. And then the Republican gets elected and the Republican decimates the deficit, destroys it just keep increasing it. But the truth is every president has done that, Democrat or Republican. But they all cry on the opposite side of the table. That's how that works. Now, so the auto industry, they don't care. That's why the auto industry gives money to both the Democrats and the Republicans, because they know that if there's an economic recession or a great recession or something like that, they may need the help of the government to stay in business. So that's why you could clearly see that they know it's whatever party is in charge is the party that's going to be there to support us. So that's why they always give campaign contributions to both sides. So when you're doing the sales forecasts, and you've had some experience in doing this, you have to get hopefully a consensus, meaning that don't leave just one person in the business to make the sales forecast. It's generally a group of people who are going to look this over, develop it, okay it, and it's going to be, what we think we're going to sell. So some companies may have sales channels. So think of a sales channel like this. Say you're a cell phone manufacturer and you sell to cell phone stores, or maybe you're Apple and you sell to Apple stores. You could get feedback from the stores saying, hey, we have a backlog of this many people who want to buy the new iPhone, or we have already pre-orders, so they get a better idea of how to forecast their manufacturing. Even if, say you're a movie theater and a new movie's coming up, you can pre-purchase your movie tickets now in this day and age. So a big movie that's coming out, we can look and see, okay, this has set records for the amount of pre-sales, so we know exactly how many people want to see this movie. We can, if it's in a small theater, let's move it to a bigger theater and sell even more tickets, or open up. Well, they wouldn't move it. They would just say, okay, this theater's full, take the other theater, make that available for more ticket sales, so they have a better, easier time of knowing exactly how many seats are going to be full the first weekend of a new big release. Previously, before this online advanced ticketing, you just didn't know. You just hoped enough people would show up that opening night or that opening weekend to see the movie. It's one of the things that makes forecasting easier if people can purchase your product in advance, so you have a better idea of how much demand you need to meet. So it's just, some companies, it's trickier to do a forecast, and certainly new products are harder to forecast what the demand will be, if people overall will like this new product or reject the new product. So forecasting is something that companies will spend a lot of time on, and communication-wise and data analysis on, to get it as perfect as possible, as close, because you don't want to, in your company, as you can see, if you make more cars than you need, that really wrecks a lot of your financial ratios. So you don't want to have all this extra unsold inventory. And if you don't make enough to meet your sales demand, now your competitors are going to take over that part of the business and do better because of it. So the more accurate you are in your forecasts, the more efficiently your company is running, the more profitable your company will be. So anyway, the sales forecast is just the beginning point. This is the point we need to start at to prepare the cash budget, because the sales are what translates into cash and profits. And this is why in your companies you sometimes have this unrealized, unexpected deficit, and you say, I finished the year with a surplus. Where did this deficit come from? Obviously something's broken. No, you're broken. The deficit's coming from the fact that you didn't sell all the cars that you forecasted. You messed up on your forecast, you built too much inventory, they remained unsold, they never translated into cash. So your company had a deficit, which is something, unexpected deficits are something investors and owners of companies do not like to see happen. It's very upsetting. Okay, so when you prepare the cash budget, like we saw the other day, you have to total up your cash receipts. How much cash did the business generate for that particular period? Maybe it's a month. So if anybody ever here worked in the cash business, you know that at the end of the night, you have to add up all the cash, deposit in the bank. So if it was just purely a cash business, it would just be the cash coming in, and at the end of the month, you would add up all the cash receipts, the cash that's deposited every night, to see how much cash the business generated for that month. Other businesses get a little bit more, can be a little more technical if you're accepting credit cards, and even more technically difficult if you're issuing credit to your customers in the form of accounts receivable, because the accounts receivable doesn't get paid uniformly. So if you issue accounts receivable to other companies, they'll decide to pay you back in 10 days, 20 days, 30 days, 90 days, 160 days. It's up to them. You're going to encourage them to pay back as soon as possible, maybe by adding some discounts, some encouragement, or just nagging them to pay you back, encouraging them, sending invoices, phone calls. So the cash receipts is really just a synopsis of what's been collected. Cash disbursements is a synopsis of what's been spent. How much money is your business spending? What cash are they spending? What materials are they purchasing? So how the cash receipts flow. So we look at, this is the cash budget. So in the cash budget, we're going to put down our total cash receipts less our cash disbursements to get our net cash flow. And we're going to combine that with the beginning cash to get our ending cash. And then see what type of financing we may need. So basically we're looking at if we have, companies have financing requirements, they always have to have a minimum amount of money, say, in their checking account. So their ending balance, a lot of companies would say, and would be a good idea when you run your companies to maybe have $10 or $15 million as a minimum balance of cash surplus before you start the next year as a cushion. In case you don't sell all the cars you forecasted, you won't go into a deficit. But if you end the year and your cash is, your cash surplus is zero, you don't have much of a cushion in case your sales forecasts don't materialize. So in the cash collection, in this particular example of cash receipts, the companies collect 20% of their cash immediately. So if we focus on this $100, $20 is collected, or 20%. $200 would be 40, and then we'll stay with October. So cash sales, October has $400 of cash sales, $80 is collected immediately in cash. So $80 is paid to them in cash. $100 of the cash receipts comes from September, what we call a lagged 1 month. So in 1 month, it took, for this $200, we received 50% of that in October. The second lag month is 30%. So of this 100, 2 months lag, 30% or $30 is here. So you see how it's staggered, the collections of the cash, because of the accounts payable. And that's why you don't, in the month of your cash receipts, you may have sold $200 worth of product, but you only collected $90 of cash receipts because the cash receipts are staggered. So that's something companies, another complication companies have to figure out. For example, your tuition bill is due at a certain month. So if you were thinking you were just going to take the cash that you generated that month to pay your tuition bill, you wouldn't have enough cash. So you know that things don't always happen in the same time frame. Money has to be saved or spent in a staggered, collected or spent in a staggered position. Now moving to the cash disbursements, purchases are usually tied to sales. So if you're a mattress company and you expect to sell 200 mattresses at your retail location, you're going to have to go and buy 200 mattresses to be sold. And if you have the mattresses, basically say $100 mattress that you're selling for $100, generally costs you 70%. So you're going to buy the mattress for $70, sell it for $100. So if that's sort of your 30% markup, you could say that whatever my sales are, the 70% of those would be the purchases I need to make. Now, when you make those purchases and when you pay them are two different things. So you generally need to make purchases in advance before you have your sales. So a lot of times, if you're looking at September sales, you need to make purchases in August to pay for September sales. Each problem that you do in this category would specify what the laggard time would be between the sales and the lead time before you buy the materials. So mattresses are pretty easy. You can just get them in and sell them. Other manufacturers may need 2 months, may have to buy the components 2 months in advance, and it takes 2 months to assemble. For example, if you're Boeing and you're going to deliver an airplane, it could take a year to buy the materials and assemble and manufacture before you're ready to sell. So that would be an extreme example. Now, as a company, as you take on your purchases, maybe some of your purchases here, 10% of purchases are made in cash. And then the rest, the 90%, are going to be put on an account. So, which you pay 70% of those in 30 days and the remaining 20% in 60 days. So if you purchase $70, 20% or 14 would be paid you purchased it in August, you're paying it 20% in October. So it just means that you pay back in a staggered rate as well. Some vendors you pay back in 30 days, some vendors you wait 60 days. And it might just be the difference between, okay, these vendors we want to pay back in 30 days because if we don't, we get charged a late fee. These other vendors don't charge a late fee, and they're cool with us paying them back in 60 days. In fact, the terms are 60 days, so we'll just pay them in 60 days rather than 30 days. So that's why we have this laggard month on our distributions. And then things companies have to pay periodically. They're going to be paying wages, salaries, wages, taxes. Maybe there's money for a fixed asset they have to purchase, or interest on a loan, or cash dividends they're going to make. So these are all different cash disbursements that we need to categorize in months. So we get an idea of what we're spending in months. And the purchases for the month are not going to be the same as the distributions because of the staggered nature and these additional distributions companies have to make. Here's a terrible example. Here's a nice wall of words for you. Probably, if you look in the book and said, this is how not to make a PowerPoint slide, this would be a good example, because no one wants to look at that mess. But this is basically an example that we have done in a spreadsheet. And before you do a cash budget type of problem, you need to know the specifics of a company. So here they're telling us about the company's sales. And then they're telling us about how the company collects the cash and what percentage they're collecting the cash. And they talk about the accounts receivable, how they pay, any bad debt. Something we didn't talk about, bad debt expenses, uncollectible debts. So sometimes we have a few bad apples that don't listen, and they just not going to pay back their debts. So they're uncollectible. So this happens in business. Sometimes you lend money to companies, entities, or individuals, and they don't pay it back. And that's called, we make a bad debt allowance. We make an allowance for this. We expect that a certain percentage, maybe 1 or 2%, this is going to happen to. And it's just the cost of doing business. But then we learn from this, and we say, never lend to them again unless they pay us back. You know, because we're not going to be fooled twice. I'll take your question at the end of the class. I'll hold on to it. Let's see. Okay, so things we need to know is the sales forecast. What are they forecasting their sales to be? Then we need to know our cash collection. Then we need to know our accounts receivable collection. So we have that they're saying that a percentage is going to be lagged by a month, and a certain percentage will be lagged by 2 months. We need to know what our cash receipts are. So there's a lot of this fine detail of information before we can even calculate the cash receipts. Specifics about the company. Same thing with the cash disbursements. What is, when we do our purchases, what is the percentage of sales we're tying that to? How do we pay our purchases back? Cash, credit, what are our terms? Are there any discounts? If we're looking at how is our rent payments structured, our wages and salaries, is it every weekly? Is it biweekly? Our fixed asset outlays, these are all things that we saw in the example. So generally that has to be laid out. And we saw all this in the previous example. This is the example. The data here is exactly what they're talking about in this example that has been laid out. So when we want to prepare, we do the cash disbursements and cash receipts because we need this to generate the cash budget. Just like you would want to do too if you're going to look at what do I have to, let me collect all my bills to see what I have to pay for the month, and then let me try to forecast all my particular sources of cash flow. What are my side hustles? What is my main job? You know, and maybe even down to what coins do I have in the couch that I could take back and put in the coin machine at the bank, trying to assess all your sources here. And in preparing the cash budget, we're going to look at, basically going to start at beginning cash, we're going to look at the change in our cash flow, and then an ending cash. Because we want to know what our required financing is going to be. So if you're working on the company, you know, so if you're, hopefully you're not working on the company as I'm lecturing here, that you're paying attention and you're not working on the company and talking to each other, but you're thinking about this lecture that you're going to need to know for the exam that's coming up. And for a company, the reason we put this cash budget together is to understand what is the total financing that we need. If I'm going to have to borrow money, it can't be last minute. I need to know in advance. That's why we make the cash budget. So if we know in advance how much money we're going to borrow, we can start asking now, because we can't ask last minute. And if we have an excess amount of cash balance, we may want to look into investing that temporarily to get some return on that. Or maybe even making an investment and buying another company. Okay. So this again, here's a cash budget with information from the example that we had just done. So here we're looking at October, November, and December. And what we're seeing here is we have a cash receipts and a cash disbursement. So if we're receiving in 210, but we're spending 213, that's a net cash outflow. So if we combine that with our beginning balance, so our beginning balance is 50, we get an ending balance of 47. We need a minimum cash balance of 25. You'll see that in the companies you're running. If you look at your balance sheet, you'll see that the cash balance is always set to, the cash account's always set to 25 million, because that's your minimum balance. And anytime you go below that, that's what they calculate a deficit. So if you have only 15 million in your cash account, it's going to show a 10 million deficit on your pro forma financial statement. So here, we started at 50, adding into it the net cash outflow, negative cash outflow. Now we're ending the cash at 47. But since our minimum is 25, we have a surplus of 22. So we don't have to worry about that. Now, going into November, again, we look at our cash receipts compared to our outlays or disbursements. We have a bigger cash outflow. Our beginning balance is last year's ending balance. So we see that now we have an ending balance of negative 51. We have to get back up to 25. So we're going to have to borrow $76 to pay back the deficit of 51 and have a remaining surplus or minimum cash balance of 25. So this is basically, it just keeps repeating, and the balances keep getting moved up. So the amount of financing required is going to be growing or shrinking depending on what the disbursements are related to the cash receipts. So this is what companies do, and they might do this for 6 months or for a year. And if they go for a year and they see that they have this huge requirement of financing, either they go to try to collect and secure that financing, or they may have to change their business model and say, okay, we need to raise prices, maybe lower some costs, do something, delay a purchase, because we really can't swing such a big amount of cash deficit. And it's the same thing when you run your companies, and the first time you did it, you may have seen a huge cash deficit that prevented you from proceeding, and you had to go back and sell some factories, reduce some operational investments, maybe increase your prices, reduce your costs, so that way you could have less of such a deficit. And that's basically what you did, was you're evaluating your cash budget, even though you don't formally have a cash budget in your company. But when you see a giant surplus and you can't progress forward, you have to go back and evaluate your cash budget and increase your cash, so that, and the easiest way generally is, if a company wants to increase their cash, they're going to look at the cash budget and see where the problem is. It could be that they're spending too much on new purchases of equipment, factories or machinery. They could reduce that. They might just see that the operation, the operation of the company, their sales just aren't generating enough profits. So there they would go back and raise prices or lower costs. So the cash budget is going to help managers identify, first and foremost, if there's shortages or excess or surpluses, and then planning tools to figure out what can we do to meet our goals. And sometimes it could be setting up, if you see that, okay, we're going to run out of cash, we can set up borrowing arrangements. This is unavoidable. We need to make these purchases now. We're going to have these for 20 years. It's just happens to be a year where we're spending a lot. Let's make arrangements. We can borrow short-term debt, long-term debt, or maybe even issue an IPO. These IPOs are a great way to bring a lot of additional cash into a company that is going to have losses for many years, like Amazon did, Uber, Lyft, these types of new companies. So there's always uncertainty in that cash budget. And you see this when your company goes from one year to the next. You look like you should have had a surplus. Now you had an unexpected deficit because of this uncertainty. The forecast could be wrong. And if the forecasts are wrong, you're going to have a scenario where you have a bigger deficit than anticipated. And it could even lead to the bankruptcy of the company. So a lot of companies might do what's called a scenario analysis, where they're going to look at preparing several cash budgets based on a pessimistic, a most likely, an optimistic scenario. So this way the companies can kind of get a handle on, in the worst case, what's the worst case we could expect for our sales? Let's reset the cash budgets in the worst case and see if our company has a stress test could handle that financing needs. And then let's see what would be in the best case scenario, so that way they're more informed about the different trajectories of the company based on maybe economic or customer demand. Okay. Let me just... So I see where I am. Okay. Okay, so here is a scenario analysis of pessimistic, likely, and optimistic for each of the 3 months. So this, again, let's plan for let's take the most pessimistic, and if we can handle that, then I think we're pretty confident that any scenario that's going to come up, we can manage as a company. So cash flow within the month is going to be sort of unpredictable. So hopefully the cash budget comes in pretty close, but the way that the cash is going to inflow and outflow, the pattern through the month may be uneven. So sometimes firms may want to look at a more daily pattern, and some businesses are just easier on a daily basis than on a monthly basis or even a quarterly basis. So if you have a food business, food generally sells every day and you have a similar amount of sales every day. Or if you're in the airline industry, that's going to be some days you sell a lot of planes, some days you're not selling anything. Same thing with automobiles or dealerships. It's just a little less predictable. Okay, moving into the pro forma financial statements. Now here is what we're going to look at when we make our forecast, and you see this when you run your companies, when you make all the decisions, you get to that financial section, a pro forma financial statement is listed out there for you. And what this does is using the projected or forecasted sales to say, this is what your income statement, your balance sheet is going to look like if you sell everything that you forecasted. So comparing this to a preceding year's financial statement gives us a good idea, and you could even figure out your financial ratios and your year-over-year change, which equals your score, by calculating these ratios that we learned in Chapter 3 in a year-over-year format. So the key input, the key lesson here is the sales forecast is critical for accurate pro forma financial statements and for accurate financial and cash budgets. So that's why it's critical in the businesses that you're running that your forecasts are as accurate as possible. And if you does become inaccurate or less accurate, you have the ability to see that, investigate, interpret it, and try to give it another shot the next round to get a little bit closer. Okay, so here could be this is Fair Traders, which is a fake company's income statement for 2019. This is their balance sheet. And we're looking at that for this company, we're looking at, unit sales. They sell two things, mugs and plates, and the mugs are $25 a unit, and the plates are $50 a unit. So this would be their total sales. This is their forecast. So if they wanted to use what we call a percentage of sales method, we saw this in the spreadsheet last class. We're looking at how sales relate to cost of goods sold, operating expenses, interest expenses. So we call it a percentage of sales method. We say that everything that we sell, every dollar of sales, 80% is going to be costs, 10% is going to be operating expenses, 1% will be interest. So we could do this percentage of sales method where whatever a new sales forecast is, we can use these percentages to help predict all the other categories in the income statement. So it's just basically saying, if sales go up by 50%, we could expect other categories to go up by 50%. So we're just using these percentiles to get a better idea of what the pro forma would be, because we developed a relationship from past financial statements, what these particular categories, their relationship to sales. Some categories may have no relationship to sales, and they will not change in relationship to the change of sales. So, for example, if we're looking at rent in our facilities, this is not going to change if sales increase. The rent is fixed, it's in a lease, a contract, so some things are fixed, some things are variable. So when we saw that example in the spreadsheet the other class, we saw that there are fixed costs that don't change with sales, and there are variable costs that do change with sales. So the variable costs are the ones that we want to look at. So a major weakness of this, of course, is that we're assuming that past financial relationships and percentage of sales are going to hold true every year. And they do, they may be close, but there is going to be some variation. So we can't always say with 100% certainty that these percentages of sales are always going to be the same. They do drift. So hopefully they're always close, but then new evaluations have to be done every year to reset them. Okay. So financial managers are going to use these financial statements to help plan out the next year. So these pro forma financial statements, they're going to see, are we meeting our goals and our sales increases, our profit increases, how we're managing our assets? So you can develop a whole set of financial ratios based on your pro forma statements to see that are we making improvements in all our key ratios and areas. This is something that you can do in a spreadsheet. You can cut and paste out last year's financial statements, the pro forma financial statements, calculate the financial ratios, and then calculate the year-over-year change and almost simulate how many points you're going to earn in your management of the company. So that's basically what we're going to be using, our companies are going to be using these pro forma financial statements for. Sorry, I'm just flipping around here for a second. And then this can be used for not just the income statement, but you can make a balance sheet and a statement of cash flows using these pro forma information for the financial goals of the company. Because companies are not like individuals. Like, we could play fast and loose with our cash and what we're spending and buying and hope we don't get into too much of a problem. Companies don't have that luxury. They have people working for them. They have customers, suppliers, relationships they have to maintain. So that everything has to be calculated, verified, and projected as accurately as possible to make sure the company stays as efficient as possible. That's why there's more than a handful of students that by the time they graduate college, they've wrecked their credit. They've taken on more credit cards than they should have. They've incurred too much debt that they can't pay back. And they don't have the financial responsibility to understand what they're getting themselves into, so they just stop paying their credit cards. Some college students may stop paying their rent, and then they're surprised when there's a judgment on their credit score that the landlord placed on them because they didn't pay for their rent, or the credit cards placed these indicators on your credit scores that you didn't pay your balances, you're always late, or just abandoned the account. These will wreck your credit score. And companies have credit scores too, so they want to always get the best negotiating and lending terms and borrowing terms, and they're not going to get that if they're not credit worthy. So companies protect their credit ability and history just like individuals should. Luckily today, as individuals, many of the credit card companies provide us with our credit scores on a monthly basis, so you can get a better idea of what's affecting them and how. And companies are very concerned about that too, because if they get labeled a company that is not going to pay, then other companies are going to be refused to do business with them. Okay, that's the end of the lecture portion of Chapter 4. You had a question earlier I asked you to hold. What was that?